In case you guys haven't seen it on the news yet, the latest housing data released by CoreLogic shows the Australian property market growing at the fastest rate in 32 years. This means that in my entire lifetime, the Australian housing market has not seen a faster rate of growth. The March housing data shows a 2.8% increase in CoreLogic's Home Value Index, which is the biggest monthly growth since 1988. What is even more amazing is that Australia's most expensive market, Sydney, actually saw the biggest growth, recording a staggering 3.7% increase in March and a 6.7% increase over the quarter. To give you guys some context, that 6.7% increase has added around $73,000 to the median house price in Sydney over the last 90 days, which equates to $6,000 per week or $877 per day. At the current rate of growth, Sydney will see a growth of around $300,000 by the end of 2021, which is more than the average salary of a doctor in Australia. If we then look at the breakdown of the growth seen in the other capital cities, Hobart was the second best performer, with a growth of 3.31%, and Melbourne, Canberra and Brisbane were not far behind, all recording a growth of around 2.5%. There is without a doubt that we are currently in a property boom, but these numbers are quite amazing even for a boom cycle. As my long-term viewers will know, I have been very bullish on property since this channel started about 6 months ago. When I first started predicting a property boom, I was flooded with negative comments, while all the people predicting a 30-40% crash were held to as heroes. This just shows why it is so important to do your own research and due diligence and don't rely purely on someone else's opinion. Extreme headlines predicting a crash of 30, 40 or 50% in Australia is going to get a lot of attention and a lot of views, but it is not necessarily what's going to happen. At the same time, we can't let these property boom headlines that we are seeing right now cloud our judgment. The growth that we are seeing in our current markets is amazing and great for everyone that owns property, but it is also fueling the level of FOMO that is happening in our market, and I believe that is what's driving our growth right now. In today's video, we will be discussing the sustainability of this housing boom and discuss some important factors that will decide if this housing boom is going to be ongoing or short-lived, as well as the likelihood of government intervention and increased interest rates in the short term. We will also look back at history to get some indication of what is likely to happen in the coming months and years, and how this will affect the housing market. This video is going to be packed of useful content, so make sure you watch it till the very end so you don't miss anything. As always, please understand that this is not financial advice and I am not a financial advisor. I am simply sharing with you my personal opinion. I will strongly encourage you to do your own research and due diligence and seek the help of real financial experts before jumping into any big investment or financial decisions. And without further ado, let's get straight into the video. Let's start by talking about our record low interest rates and its effect on our borrowing capacity. With wage growth, migration and population growth all at a standstill, I believe the only thing that is driving up property prices is debt. Debt, which is a direct result of record low interest rates, which in turn has increased the borrowing capacity of eager buyers. And according to the latest data, is made up mostly of first home buyers. With the axing of the responsible lending practices soon to take place, we are likely to see an even higher borrowing capacity for these eager buyers, which in turn is likely to drive up house prices even further. As an investor with multiple investment properties, I am very happy to see the growth in my investments. However, at the same time, I am very concerned about the current situation. I have no issues with people borrowing money to get into a property, and I'm very happy to see the level of home ownership in Australia is increasing, because after all, it is the Australian dream to own your own home. What I am concerned about is the amount of debt that people are taking up to get into the more expensive markets like Melbourne and Sydney and even Canberra. With more relaxed lending practices on the way, we are likely to see eager buyers take up even more debts, which I think is quite dangerous. If buyers are stretching themselves financially and maxing out their borrowing capacity at the current low interest rates, what will happen when the interest rates increase in the long run? I think it is very important for anyone looking to purchase a property under the current conditions to realize that the massive growth that we are seeing right now is largely due to record low levels of supply and record low interest rates, and both of these factors will go up in the near future. Even though the government and the central banks have promised that we will not see higher interest rates in the next 3 or 4 years, I personally believe we will see higher interest rates much sooner than that because of inflation. We have already seen 6 consecutive weeks of interest rate rises in America, And we have even seen our own banks increase their long-term fixed rates, with CBA increasing their 4-year fixed rate by 0.2%. These are all indications that interest rates could rise sooner than expected. And this is why I'm personally starting to take advantage of longer fixed-term rates. With the high levels of debt that many first-home buyers are taking up, I am very concerned about their ability to make repayments when the interest rates do increase. Even though rising interest rates is not an immediate concern, someone looking to borrow a few $100,000 or even $1 million should be confident of their ability to make repayments in the long term. But there is something that is an immediate concern, and that is what we have seen in New Zealand. And that is government intervention. As a direct result of runaway house prices, which grew by 23% in 12 months, the New Zealand government have imposed tough regulations to cool their housing market, including new measures to prevent investors from offsetting their interest on their loans as an expense against rental income, essentially scrapping negative gearing. As most of you guys already know, almost every house in Melbourne, Sydney and Canberra are negatively geared. If the Australian government was to impose similar measures and scrap negative gearing for Australian investors, the markets that will be most affected will be Sydney, Melbourne and Canberra. If you don't think government intervention is a possibility in Australia, then I would suggest you to go back a few years and look at what happened in 2017 and what that did to our property market. As a direct result of booming house prices, APRA imposed lending restrictions which had an immediate effect on the housing market. We saw a significant decrease in home values, especially in our most expensive cities, and no surprises, Melbourne, Sydney saw the biggest corrections. However, during the same period, there was a market that performed extremely well, and that was Hobart. In my previous videos, I've spoken a lot about the importance of rental returns, low vacancies and housing supply. Hobart ticked all 3 of those boxes, and as a result, it has been performed strongly since 2017. If you think about it, it makes perfect sense because investors in Hobart did not stretch themselves financially because their houses there were so cheap, and they had rental returns of up to 6% and practically 0 vacancy rates. All of that combined meant that investors had almost nothing to worry about, and as a result, they were happy to hold on to their properties and drive up house prices during a period when most markets were underperforming. So if you're looking to invest in property, make sure you invest in the right market. Now, let's go back to the headline that we started this video with. The strongest growth in 32 years. The last time we saw this level of growth was in 1988, where the interest rate was a staggering 17%. Despite the record high interest rates, the property market continued to boom. And mind you, this was right after the 1987 stock market crash, which saw the ASX drop 40% of its value. Strong price growth in real estate following a major stock market crash. Does this sound familiar? It is actually amazing the similarities and the trends that we can find by looking at history. A thing to note here is that following 1988, the Reserve Bank of Australia dropped the cash rate aggressively, and despite the strong rate drops, the growth in the housing market slowed down dramatically in the years following 1989. So what does all of this mean? Well, let's sum up all of this together. The current housing market is on fire, fueled by record low interest rates, massive amounts of FOMO and record low levels of supply. As we have seen in Australia back in 2017, and as we have seen more recently in New Zealand, the government will step in and cool the market if they think the market is getting out of control. I personally believe if our property market keeps growing at our current levels, we will see government intervention by the end of this year. This, along with the possibility of sooner than expected rate rises, is likely to cool the property market. By drawing similarities from the last time we saw this level of growth back in 1988, the growth cycle did not last very long, and the housing market was stagnant for a few years afterwards. All of this combined with affordability constraints as buyers max out their borrowing capacity again and again, we are likely to see the housing market cool significantly in the coming months. I will strongly encourage anyone looking to purchase a property to realize that this kind of growth is not sustainable over the long term, and to only borrow within your means. Under any economic environment, we should never overstretch ourselves financially. This is even more important now under the current economic environment. With so many uncertainties in the global economy, we need to proceed with caution. With that said, none of this is financial advice. I'm simply sharing with you my personal opinion. I would strongly encourage you to do your own research and due diligence and seek the help of real financial experts before making any big financial or investment decisions. Thank you for watching the video till the very end. If you got value from this, please support my channel by hitting that like button right there and subscribing to the channel for more content just like this. And I'll see all of you guys in the next video.